Hello everyone, welcome back to the channel. Today I want to focus on a question that, in my view, is becoming increasingly important for global markets. Why are stocks falling, and what exactly is the market afraid of? Is the real problem rising oil prices? Is it inflation? Is it the sharp increase in long-term US Treasury yields? Or are we simply seeing a normal correction after a very strong rally in equity markets? When I look at the market today, I do not think these developments should be analyzed separately. I see a chain reaction. Oil prices rise. Higher energy prices increase inflation concerns. Inflation concerns push bond yields higher. Higher bond yields increase the discount rate used to value financial assets. And ultimately, higher discount rates put pressure on equity valuations, particularly the valuations of growth and technology stocks. That is the framework I want to use throughout this video. Before we begin, a quick reminder. Everything I discuss here is for educational and informational purposes only. Nothing in this video should be considered investment advice. My objective is not to tell anyone what to buy or sell. I want to explain how I read the macroeconomic environment, the technical levels, and the risk-reward structure of the market. Let me start with Wall Street. The S&P 500 declined approximately 0.5% to 7,745.06. The Dow Jones Industrial Average also lost around 0.5% and closed at 53,459.78, while the Nasdaq declined roughly 0.3%. What is particularly interesting is that the weakness was relatively broad. 10 of the 11 major S&P sectors declined. Communication services were among the weakest areas, while energy was the only sector that managed to move higher. That distinction matters. When oil prices rise sharply and energy stocks outperform while most of the rest of the market falls, I see that as an important signal. It tells me that the market is beginning to price the consequences of higher energy costs. The VIX also increased to 15.19. Now, I would not describe a VIX around 15 as panic. We are very far from a genuine volatility shock, but the direction matters. Volatility is rising at the same time that bond yields and oil prices are rising. That combination deserves attention. The first variable I am watching is oil. Brent crude rose approximately 2.9% and reached $91.10 per barrel. West Texas Intermediate was trading around $85.30. For me, the importance of oil is not simply whether Brent is at $85, $90, or $100. The real issue is what higher oil prices do to inflation expectations. Energy is embedded throughout the economy. Transportation costs increase, production costs increase, shipping costs increase. The cost of chemicals, plastics, and many industrial inputs can rise. Eventually, some of those costs can reach consumers. That is why a sustained increase in oil prices can complicate the inflation outlook, even if core inflation had previously been moving in the right direction. And this brings us directly to the Federal Reserve. Markets are now discussing whether a persistent inflation shock could potentially force the Fed to remain restrictive for longer or even reconsider the possibility of another rate increase before the end of the year. I want to emphasize the word persistent. A one-day move in oil does not change monetary policy. A one-week move does not necessarily change monetary policy either. What matters is whether higher energy prices become sustained enough to influence inflation expectations, consumer prices, corporate pricing decisions, and eventually the Fed's reaction function. That is the key distinction. And the bond market is already telling us that investors are taking this risk seriously. The US 10-year Treasury yield increased by around 3 basis points to 4.72%. The 2-year yield rose to approximately 4.18%, but the most important number for me is the 30-year Treasury yield. It increased by around 5 basis points to 5.31%. That is the highest level since 2007. I think this is one of the most important numbers in the entire market right now. Why? Because the 30-year yield reflects much more than expectations about the next Fed meeting. Long-term yields incorporate inflation expectations, fiscal risk, treasury supply, term premium, and the long-term credibility of monetary and fiscal policy. Investors are looking at large government spending requirements, increasing treasury issuance, and inflation that has spent much of the last 5 years above the Fed's target. So when the 30-year yield moves above 5% and reaches 5.31%, I do not treat that as background noise. It directly affects asset valuation. Let me explain why. When interest rates were extremely low, investors were willing to pay very high multiples for future earnings. The logic was simple. If the risk-free return available from government bonds was close to zero, equities looked relatively attractive even at expensive valuations. But when treasury yields rise toward 5%, that calculation changes. Suddenly, investors can earn a meaningful nominal return from what is considered one of the safest assets in the global financial system. That raises the hurdle rate for equities. A company trading at 30, 40, or 50 times earnings has to justify that valuation against a much more attractive bond alternative. This is particularly relevant for long-duration growth companies. Technology stocks are essentially long-duration assets because a large portion of their expected value comes from profits investors expect many years into the future. When discount rates rise, the present value of those future earnings declines. That is why bond yields matter so much to Nasdaq valuations. Interestingly, technology did receive some support during the session. Semiconductor stocks performed relatively well following reports of very strong growth at Anthropic. According to the market report I am using, the Philadelphia Semiconductor Index increased approximately 1.6%. There were also major AI infrastructure developments. NVIDIA reportedly agreed to spend as much as $105 billion to support a new Ohio data center campus that would be leased by OpenAI. This demonstrates something very important. The structural AI investment theme remains powerful, so I do not see the market as a simple story of technology is finished. That would be far too simplistic. What I see instead is a conflict between two powerful forces. On one side, we have extraordinary investment in artificial intelligence, semiconductors, data centers, and computing infrastructure. On the other side, we have increasingly expensive capital. That tension can create a market where earnings remain strong while valuation multiples become more difficult to expand. And this is exactly why I want to separate company fundamentals from market valuation. A company can deliver excellent revenue growth, it can increase profits, its long-term story can remain completely intact, and the stock can still fall if investors decide that the appropriate valuation multiple should be lower because treasury yields are higher. That is one of the most important lessons in financial markets. Price is not determined only by earnings. Price is determined by earnings multiplied by the multiple investors are willing to pay for those earnings. If the earnings rise but the multiple falls, the stock price can still struggle. Now let me move to the S&P 500 chart because I think the technical picture gives us a much more balanced view than the headlines. On the daily chart, I still see an established bullish structure. The index is trading around 7,689 and remains significantly above its major moving averages. The 14-day moving average is around 7,711. The 50-day moving average is approximately 7,534, and the 200-day moving average is close to 7,098. That structure is still constructive. The 50-day average remains well above the 200-day average, and the index is still trading above both of them. So based purely on the daily chart, I cannot yet describe the current weakness as a confirmed major trend reversal. For me, the first resistance area is around 7,711. If the index can regain that level and sustain itself above it, the psychological 8,000 level comes back into focus. And I think 8,000 would be an extremely important psychological and technical level. But the downside levels are equally important. The first major daily support I am watching is the 50-day moving average around 7,534. During a healthy uptrend, the 50-day moving average often acts as a reference point for institutional investors. As long as corrections remain above or around that area and buyers continue to appear, I tend to interpret the weakness as consolidation within the broader trend. If 7,534 breaks decisively, however, my interpretation begins to change. That would increase the probability that this is not simply a short-term pause. Below that, the 200-day moving average around 7,098 becomes the major long-term structural support. I want to be very clear here. There is a significant difference between a market pulling back from record highs and a market entering a confirmed bear trend. At the moment, the daily S&P 500 chart is still much closer to the first description than the second. But when I move to the 4-hour chart, the picture becomes more cautious. The index has fallen below both the short-term 14-period and 50-period moving averages. Those are around 7,742 and 7,752. That creates an immediate resistance zone. For short-term momentum to improve, I want to see the S&P regain roughly the 7,741 to 7,752 area. If that happens, 7,800 becomes the next level I would watch. If the market cannot reclaim that zone, then the 200-period moving average near 7,573 becomes very important. And below that, I see approximately 7,400 as the next meaningful support zone. So my short-term framework is quite simple. Above roughly 7,752, momentum begins to improve. Around 7,573, we test the integrity of the short-term trend. Below that, the probability of a deeper correction increases. There is also an interesting momentum signal. The 4-hour stochastic momentum index has fallen to approximately minus 90. That is an extremely oversold reading. Now, oversold does not mean that the market must rise immediately. That is a common mistake. A market can remain oversold for longer than many investors expect. But when I see an extremely oversold momentum reading, while the larger daily trend remains positive, I become cautious about chasing the market lower. Historically, very depressed momentum readings can create conditions for short-term rebound attempts. So this is exactly the type of environment where I prefer scenarios rather than predictions. My first scenario is the constructive scenario. Oil stabilizes. Treasury yields stop rising. The S&P 500 holds the 7,573 to 7,534 region. Short-term momentum recovers. The index moves back above 7,752. In that situation, I would interpret the current decline primarily as a correction inside the broader uptrend. The next important levels would then be 7,800, followed eventually by the psychological 8,000 area. My second scenario is more defensive. Oil continues to rise. Inflation expectations increase further. The 10-year yield moves sustainably above current levels, and the 30-year yield continues pushing beyond 5.31%. The S&P then breaks 7,573 and, more importantly, loses the 50-day moving average around 7,534. At that point, I would become much more cautious. I would then start looking toward the 7,400 region and potentially lower levels if selling pressure accelerates. My third scenario is perhaps the most frustrating one for investors. The market simply moves sideways. Oil remains elevated but does not explode higher. Bond yields remain high but stabilize. Corporate earnings remain reasonably strong. In that environment, the S&P could spend time consolidating between support and resistance while valuations gradually adjust to higher rates. And I think investors sometimes underestimate how important sideways markets can be. Prices do not always need to crash to correct an expensive valuation. Sometimes earnings rise while prices remain flat. The valuation multiple then declines naturally. That is a correction through time rather than a correction through price. There are also several catalysts I am watching closely. The first is the US consumer. Walmart, Home Depot, and Target are expected to report results. Those earnings will be particularly important because retail sales recently recorded their sharpest decline in more than a year. I want to know whether the American consumer is genuinely weakening or whether the recent softness is temporary. The second catalyst is the Federal Reserve meeting minutes. I will be looking for any indication of how concerned policymakers are about persistent inflation and whether the threshold for further tightening has changed. And the third major catalyst is Nvidia's earnings next week. Given the enormous importance of AI-related capital expenditure, Nvidia has become much more than an individual stock. It is effectively a barometer for expectations surrounding the artificial intelligence investment cycle. But even strong Nvidia results will have to compete with the macro environment. If bond yields keep rising aggressively, strong earnings may not automatically translate into higher equity prices. That is why I keep coming back to the same point. The real question is not simply whether stocks are falling. The real question is why the discount rate is changing. When I put everything together, my current interpretation is this. I do not yet see evidence that the long-term S&P 500 uptrend has definitively broken. The daily technical structure remains constructive. The index remains above its major 50-day and 200-day moving averages, but the short-term structure has clearly weakened. At the same time, Brent above $90 and the US 30-year Treasury yield at 5.31% represent a macro combination that I cannot ignore. So I am not trying to predict whether tomorrow's candle will be green or red. I am watching the transmission mechanism, oil, inflation expectations, Treasury yields, equity valuation multiples, and then the S&P's reaction around the technical levels. For me, 7,752 is the first short-term level that would indicate improving momentum. The 7,573 to 7,534 region is the crucial defensive zone, and 8,000 remains the major upside psychological level if the market can regain momentum. If yields stabilize and those supports hold, I would still view the broader structure as constructive. If oil continues higher, yields accelerate, and the S&P loses its 50-day moving average, then I would have to reassess the risk of a deeper correction. That is how I approach markets. I do not need to know the future with certainty. I need to know which variables matter, which levels matter, and what would make me change my interpretation. Because risk management is not about predicting every market move, it is about preparing for different outcomes before they happen. If you found this analysis useful, you can subscribe to the channel and follow the upcoming videos where I will continue analyzing global markets, interest rates, gold, currencies, and equities through both macroeconomic data and technical levels. Thank you for watching. I will see you in the next video.